Hey, this is Jim Duffy with Alcova Mortgage, and I want to talk today about debt consolidation, or rather a cash out refinance, and how to structure that, because the question's coming up a lot these days. The good news is we all have a lot of equity in our homes, right? And the question becomes, well, what do we do with that? Well, on the one hand, you can just keep paying down the mortgage and pay it off, which is great, but what if you want to put it to use? Here's the criteria to look for. Do you do a home equity line of credit or a new cash out refinance, a new first mortgage, right? And it depends. So a lot of people pull cash out for different reasons, right? You can pull the cash out to put the money down on an investment property and buy that, or to consolidate debt and really improve cash flow, any number of reasons, right? And they're all valid and they're all good and they're all a good use of your equity. Now it comes to, how do we use the equity, right? Is it short-term, is it long-term? I had someone just recently call, a couple weeks ago, just call and say, hey, I want to do some home improvements. I really want to pull some cash out or tap into the equity for this, but I've got a big bonus coming at work, but it's not coming for about 4 months. We'd really like to do the home improvements now because actually this was just before the holidays, and you understand, families coming in, you want to show off the house, you want the home improvements to be done, right? And so it made sense, but it's going to be short-term money. They had a good interest rate. I actually helped them with their purchase loan, so obviously they had a good interest rate. And we didn't want to touch that because rates are up just a little bit. So in this case, I recommended let's do a home equity line of credit. The home equity line of credit worked very well because it's short-term. Now, the opposite's also true. I have a lot of other people who are doing debt consolidation where it's really going to be longer term, right? You're paying off several credit cards, maybe a car, maybe a student loan, and really improving cash flow in the household. And that's great, but it's going to be longer term because it's not something where there's a bonus or a big payout coming to pay it off and rectify that. So I have some people who are at an interest rate in the 2s right now, and they're going to move up to the 3s because the cash out refinance is a higher rate if you're doing a first mortgage. However, here's the criteria to look at. If it's short term, we're in a rising interest rate environment right now. The Fed says they're going to raise rates 3 or 4 times this year, a few times next year. Home equity lines of credit are tied to the Fed funds rate. So as the Fed raises rates, it doesn't affect mortgage rates directly, but it does affect a home equity line of credit extremely directly. Because home equity lines of credit are tied to prime. Prime is always 3 percentage points above the Fed funds rate. So the Fed goes up a quarter, your prime rate just went up a quarter, therefore your home equity line went up a quarter as well. And if that happens 3 or 4 times during the year, pretty soon you're paying a much higher rate if you're going to keep that. So what do? Planning is the key, and knowing how long you need these funds is the key. If it's short term because you're getting the bonus and going to pay it off, do a home equity line of credit if you have a good rate on your first mortgage. But if you don't, even though you're going up on rate a little bit in your new first mortgage to do a cash out, it just makes sense because it's safe. And what you want to do above all with your primary residence is keep it safe, not put anything at risk. So if you go from 2.75 to 3.25 or somewhere in that range, it feels bad to go up in rate, but you're safe because you know home equity lines of credit are going to go up 1 point to 1.5 points over the next couple of years if the Fed keeps doing what they're doing. So let's be safe and plan accordingly and make sure that that cash out refinance does what you want it to do and doesn't put you at risk ever. So I hope that helps. Planning your cash out refinance is really critical to doing it right and keeping your home what it should be, safe and secure, where you live and raise your family and create the memories and sleep well at night knowing you've got this. I hope you enjoy the rest of our channel and all the experts. Everyone has so much to contribute to your home ownership. Please keep watching, and if I can help in any way with a cash out refinance or planning that, just reach out.